Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Imagine spending 20 years of your life just building a company.
Right. A huge chunk of your life.
Exactly. You grind through recessions, you build this incredible team, and you finally push your business to like a massive $15 million in pure profit.
Which is an incredible achievement, by the way.
Oh, totally. So you finally put it up for sale and you're expecting this massive bidding war. But then you realize, to your absolute horror, that you were actually getting fewer calls from buyers than, the guy down the street who's only making $5 million.
Yeah, that is a terrifying realization for a founder.
It sounds completely crazy, right? Like totally counterintuitive. But according to the raw data we are looking at today, it is the absolute reality of the M&A market.
It really is. I mean, you spend decades assuming that bigger automatically means more demand. But the private equity universe and the strategic buyer landscape, they don't operate on straightforward logic.
No, they definitely do not.
Right. They operate on highly specific mathematical constraints. And until you actually put your business on the market, you're flying completely blind to what those constraints actually are.
And that blind spot is exactly what we are tackling today. Because, well, usually when you sell an asset like a house or a classic car, there is this comforting expectation of visibility.
Yeah, you get to see the interest.
Exactly. You put a sign in the yard, you look out the window, and you can literally count the cars slowing down to look at it.
But when you sell a business, you have to keep it a secret.
Right. You're hiding it from your employees, your vendors, your competitors. So you obviously can't put a sign in the yard. You're just operating in total darkness, losing sleep, wondering if anyone out there actually wants what you've built.
And historically, founders have had to rely on anecdotes for that validation. You hear a story from a guy at the country club who supposedly sold his logistics company for some astronomical multiple.
Oh, right. The classic, I heard a guy got 10 times revenue story.
Yeah. Exactly. And you base your entire life plan on that rumor. But, anecdotes don't pay the bills. And they certainly don't close deals.
Which is why we are looking at something completely different today. We have our hands on the Axial Pursuits Report, specifically the first half of 2026.
A phenomenal data set.
It really is. This isn't a survey of how buyers are feeling or, a bunch of economists predicting the future. It is a massive stack of raw, quantitative platform data. It shows exactly what buyers are clicking on, what they're ignoring, and what they're actually fighting over right now in the lower middle market.
And I love the mission of this deep dive today. We are going to translate this raw data into a strategic blueprint.
Right, so that if you are a business owner listening to this, you know exactly how the market values you before you ever even sign an engagement letter with a banker.
It is the ultimate reality check.
Yeah.
But before we dive into these numbers, I think we need to be incredibly precise about what we are actually measuring here.
Yeah, good point. The whole report hinges on this one metric.
Right. The entire report hinges on a metric called a pursuit.
Let's establish that baseline, because in M&A, there are a million different ways to measure interest, and most of them are deeply confusing.
Exactly. So based strictly on the text of this report, a pursuit is not a closed deal.
Okay.
It is not an executed non-disclosure agreement, and it's definitely not a letter of intent.
So what is it?
A pursuit is the explicit top-of-the-funnel action of a prospective buyer expressing interest the very moment a deal goes to market.
Oh, I see. So an advisor lists the business confidentially. The buyer sees a brief, anonymous teaser, and they click a button that basically says, yes, reveal the identity of this company to me.
Precisely. It is that very first impulse.
The best way I could think to visualize this, and tell me if this makes sense, is to look at television.
Okay, I like where this is going.
A pursuit is kind of the equivalent of a Nielsen rating. It tracks what prospective buyers are actively stopping to watch on their very first impulse.
Right.
Like, if signing an LOI is a viewer actually buying the merchandise from a commercial, the pursuit is the viewer just stopping while flipping channels and deciding not to change the station.
That is a brilliant analogy.
It is just the purest measurement of raw initial attraction before due diligence ruins the romance.
I think that Nielsen rating analogy is exactly how a founder needs to view this. You want to know if your specific business profile is a hit primetime show or something getting buried at 3 a.m. on a Tuesday.
Yeah, exactly. So let's look at the size of the businesses that are getting the absolute highest ratings on the network right now.
Let's do it.
The report breaks down buyer activity by grouping businesses into different ranges of EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Right, thank you. Basically the standard measure of a company's cash flow.
Exactly. And the very first thing that jumps off the page when you look at these bands is the sheer volume of activity happening in the $1 million to $5 million EBITDA segment.
It's massive.
It is the absolute engine room of the lower middle market.
It is a total avalanche of data. Just in the first half of 2026, there were over 1,000 marketed opportunities. 1,092 to be exact, just in that $1 million to $5 million band.
That is a lot of deals.
It is. And those deals generated almost 35,000 distinct pursuits. To put that into perspective for you listening, that represents roughly 72% of all the buyer pursuits in this entire massive data set.
Wow. I mean, it proves a fundamental rule of the market. Crossing that $1 million EBITDA threshold is the ultimate rite of passage.
How so?
Well, if you are sitting at, say, $800,000 in profit, you are essentially invisible to institutional capital.
Really? Just invisible?
Pretty much. But the second you cross that $1 million line, you enter the most heavily trafficked highway in the M&A landscape. You are in the zone where the vast majority of private equity firms and strategic buyers are actively hunting.
Okay, let's unpack this because this is where the data gets incredibly tricky. While that 1 million to 5 million band has the most total volume of activity, like the most total clicks, it does not actually have the highest concentration of demand.
Exactly. Total volume just tells you where the crowd is standing.
Right.
Averages tell you how intensely the crowd is focusing on a specific business.
That makes perfect sense. So those businesses in the 1 to 5 million segment averaged roughly 32 pursuits per deal.
Which is a very healthy number.
It's a great number.
Yeah.
32 buyers raising their hands. But the business is generating between $5 million and $10 million in EBITDA. They actually generated the highest average pursuits across the entire report.
Yeah.
They averaged just over 37 pursuits per deal.
Which means the $5 to $10 million range is the true, undisputed sweet spot of buyer demand.
Interesting.
The smaller range has more total buyers clicking simply because there is a massive supply of smaller businesses. But if you want the absolute maximum number of buyers fighting over your specific deal, you want to be sitting right in that 5 to 10 million window.
And this brings us back to that terrifying scenario I mentioned at the very beginning of our deep dive. The part of the data that completely threw me.
The drop-off.
Yes. We have established that crossing 1 million gets you 32 buyers. Hitting 5 million gets you 37 buyers. But when a company gets bigger than 10 million in EBITDA, the average interest drops all the way down to 21 pursuits.
It's a steep cliff.
It is. I'm going to call this the success penalty. Why on earth does the average interest plummet when a company gets bigger, more stable, and more lucrative? If a business is making over 10 million, shouldn't buyers be fighting tooth and nail for it?
It absolutely feels like a penalty to the founder. I get that.
Yeah.
You build a bigger, better machine, and suddenly fewer people are knocking on your door.
Right. It makes no sense intuitively.
But it isn't a penalty. It is simply a reflection of the architecture of capital. We have to connect this strictly to the platform data mechanics. The highest concentration of buyer activity is firmly anchored in that 5 to 10 million range because it represents the intersection of maximum affordability and maximum utility.
Okay, I'm going to stop you there and play the role of the listener for a second.
Sure, go ahead.
Let's say I have spent the last 30 years building a commercial HVAC business in Ohio. I don't read the Wall Street Journal's M&A section every morning. When you say the architecture of capital and maximum utility, what does that actually mean for my business?
Fair question. It means that when a company is generating 5 to 10 million in profit, it is large enough to serve as a foundational platform investment for a private equity firm.
Meaning they buy it to use as a base of operations.
Precisely. They buy your HVAC company, they keep your management team in place, and then they use your company to acquire 5 smaller HVAC companies in neighboring states.
Oh.
At 5 to 10 million in profit, you are big enough to be the foundation of that strategy. But crucially, you are still small enough to be acquired as a strategic add-on by a massive billion-dollar corporation that just wants to absorb your customer list.
I see. So in that 5 to 10 window, you essentially have two entirely different oceans of buyers fighting over you.
Exactly. The platform buyers and the add-on buyers.
But when I cross 10 million,
When you cross 10 million, or certainly 15 million, the actual purchase price skyrockets into the hundreds of millions of dollars.
right,
And as the price goes up, the buyer pool naturally thins out. A lot of private equity funds simply do not have the dry powder, the available cash from their investors to write a check that big without syndicating the deal.
meaning they have to bring in partner firms to split the cost.
Exactly. And fewer massive corporations can swallow an acquisition of that size without a grueling, complex board approval process.
So it's not that a $15 million company is less desirable. It's just that there are literally fewer human beings on Earth who have the checking account required to buy it.
That's it perfectly. The air gets incredibly thin at that altitude. The drop to a 21 pursuit average doesn't mean your business is flawed. It just means the universe of capable buyers is mathematically smaller.
That is a massive relief, honestly, but also a really crucial strategic insight.
Huge insight.
If you are listening to this and your goal is to have 50 buyers fighting over you to drive up the multiple, you might actually want to go to market while you're in that 5 to 10 million sweet spot.
Instead of waiting.
Right, rather than waiting until you hit 15 and finding out there's only a handful of people who can afford you.
It is a very real consideration. Timing the market based on buyer density is a legitimate strategy. But size is only one dimension of a business profile.
Sure.
If 5 to 10 million is the ideal size, we have to ask, what is the ideal industry?
Okay, yes. So we've established that hitting the 5 million mark puts you in the sweet spot. But what if I have a perfectly sized business in a, completely stagnant industry? Does the sector I'm in trump the size of my company?
It plays a massive role.
Let's look at the industry rankings by average pursuits. And the undisputed king of the lower middle market in this report is industrials.
The heavyweight champ.
The average industrial deal received nearly 31 pursuits.
To put that into real-world terms, that means every single time an industrial business goes to market, an average of 31 distinct private equity firms, family offices, or corporate competitors immediately raise their hand and demand to see the confidential financials.
That is a staggering amount of instant liquidity. Second place on the list goes to education, sitting at nearly 26 pursuits per deal.
Also very strong.
And third place goes to business services at exactly 24.
Now, the report does note that beyond those leaders, buyer interest is relatively consistent.
Right, it kind of levels out.
Yeah, most major industries are generating between 20 and 25 pursuits per deal. But those top two industrials and education, they demand a much closer look.
Why is that?
What's fascinating here is that they achieve their massive popularity in fundamentally different ways.
The way I think about it, comparing industrials to education is a lot like looking at real estate.
Okay, I'm tracking.
Industrials is like a massive, universally popular suburban neighborhood.
Sure.
Everyone wants to buy a house there. The schools are good. The commute is easy. There are hundreds of houses for sale at any given moment, but there are thousands of families looking to move in. So every single house still gets multiple aggressive offers.
That's a great way to look at it.
Right. Education, on the other hand, is like a rare, highly exclusive beachfront property. There's almost nothing ever for sale on the water. So when one tiny rundown shack finally hits the market, every billionaire in the state tries to buy it just to secure the land.
That analogy holds up perfectly when you look at the deal counts in the report.
Let's hear the numbers.
Industrials achieved its massive average despite an incredibly high supply of inventory. There were over 700 marketed opportunities in the industrial sector during this 6-month period.
700.
712 to be exact. To have that much supply flooding the market and still maintain the highest average pursuit rate per deal indicates an incredibly deep, almost violent buyer pool.
The demand is just swallowing the supply whole.
Mm-hmm.
But why? Why are Wall Street and private equity so obsessed with industrials right now? We are talking about manufacturing, distribution, heavy machinery. It's not exactly flashy Silicon Valley tech.
It isn't flashy, no, but it is deeply predictable. Buyers view the industrial sector as stable and essential, but more importantly, it is highly fragmented.
Fragmented meaning lots of small players.
Exactly. There are thousands of regional manufacturing plants scattered across the country owned by baby boomers looking to retire. It is the absolute perfect environment for those roll-up strategies we discussed earlier.
Oh, so the platform and add-on thing again.
Yes. A private equity firm can buy a foundational manufacturer and then spend the next 5 years buying up its competitors and suppliers to build a national powerhouse. The demand is insatiable because the playbook is proven.
Makes total sense. Now, contrast that with the beachfront property, education.
Right. Education achieves its high average through extreme localized scarcity.
How scarce are we talking?
The report shows that only 25 education businesses were marketed in this entire period.
Wait, really? 712 industrial businesses versus 25 education businesses.
Exactly. The buyer interest in education is strong, but it is heavily concentrated on the very few available assets. The overall pool of buyers looking at education isn't nearly as broad as the pool looking at industrials.
Right. There are fewer buyers overall.
But the severe lack of supply forces every single interested party to swarm the few deals that do surface. If you own an industrial business, you have a massive active audience.
But you're in a crowded market.
Yes. But if you own an education business, you have a rare asset that automatically commands concentrated attention.
So if you are a founder listening to this, mapping out your own exit strategy, you really have to understand the specific weather patterns of your industry.
That's a great way to put it.
If you own a manufacturing plant, you have a massive audience. You are operating in the most popular neighborhood in the country, but you also have to realize you are competing for attention against 700 other deals.
Exactly. You have to stand out.
Right. If you own an education business, maybe a specialized corporate training company or a regional childcare network, you have a rare asset. You don't have to worry about getting lost in the crowd because you are basically the only game in town.
Precisely. Understanding whether you are dealing with a market of volume or a market of scarcity fundamentally changes how your advisor should pitch your business.
That makes a lot of sense.
But looking at average total pursuits, just counting the sheer number of clicks, only tells us half the story.
Only half.
Yeah. To truly understand buyer behavior, we have to look at how efficiently a deal converts an invitation into a pursuit.
Which is a massive pivot in how we look at this data. We're moving from total volume to the actual pursuit rate.
Yes, the conversion rate of M&A.
Let's clearly define this metric because it feels like the ultimate lie detector test for a deal's quality. Pursuit rate is not the raw number of people who clicked.
No, it's not.
It is the percentage of invited buyers who elected to pursue the opportunity.
This is a critical distinction for a founder to grasp. Let's say your M&A advisor blasts your deal out to 1,000 potential buyers, and 50 of them express interest. You have 50 total pursuits, which sounds great, but your pursuit rate is only 5%.
Right.
Now imagine your advisor curates a highly targeted list of just 100 buyers, and 50 of them express interest. You still have 50 total pursuits, but your pursuit rate is a staggering 50%.
The second scenario tells me the business is incredibly high quality, whereas the first scenario tells me the advisor just, threw spaghetti against the wall to see what stuck.
Exactly. Pursuit rate measures the efficiency of the asset. How compelling is the core financial profile of the business?
Here's where it gets really interesting. Because the industries that win on raw, volume-like industrials are not the ones that win on pursuit rate.
They are not.
When we look at conversion efficiency, an entirely new hierarchy emerges.
The report breaks down the pursuit rate leaders, and financial services jumps straight to the top of the entire market with a massive 22.4% pursuit rate.
Wow, 22%.
But again, context is everything here. That 22% rate was achieved across only 16 marketed opportunities. It's a highly targeted niche sector where advisors are likely only inviting very specific, pre-qualified buyers.
Who else broke into the top tier for conversion?
Energy and renewables, along with education, also managed to break the 10% mark. But for the vast majority of the lower middle market, including our volume leader, industrials, the average pursuit rate hovers somewhere between 6 and 8%.
Okay, so if I am a founder and my banker comes to me and says, we sent the teaser to 100 private equity firms, I should rationally expect about 6 to 8 of them to actually sign an NDA? That is the baseline.
And it is the healthy baseline conversion rate, yes.
But I don't want to talk about baselines. I want to talk about the absolute freaks of nature in this report.
The outliers.
Yes. There's a table titled Top 25 Deals by Pursuit Rate. These are deals that were sent to at least 50 recipients. So we aren't talking about a statistical anomaly where a deal was sent to 2 people and 1 replied.
Right. These are fully marketed deals.
And the numbers here are mind-bending. Look at the number 1 deal on this list. There's a transportation company. 35 to 40 million in revenue and 9 to 10 million in EBITDA.
A very healthy size.
That deal was sent to 74 buyers, and 34 of them pursued it. That is a 46.0% pursuit rate. Nearly half the people who saw it demanded to buy it.
And we look at the mechanics of that specific company, it makes perfect sense. It is a large, highly profitable transportation business sitting right on the absolute edge of that magical $10 million EBITDA threshold we spent so much time discussing earlier.
Right, the sweet spot.
It is the exact textbook profile of a highly coveted platform acquisition for a major logistics roll-up.
I get that. That makes sense. But then you look at the number 2 deal on the list, and it completely shatters the textbook.
Oh, this one is fascinating.
It is a food and hospitality deal.
Yeah?
The top-line revenue is tiny, only $1 to $5 million. The EBITDA is also tiny, just $1 to $2 million.
Right.
Yet it achieved a 44.3% pursuit rate. It was sent to 79 buyers, and 35 of them pursued it.
It is easily one of the most fascinating data points in the entire report.
I mean, I'm going to push back hard on this one. How does a sub-$5 million revenue food business get almost half of all invited buyers to pursue it? We just said the baseline conversion rate is 6 to 8%.
It defies expectations, absolutely.
If I have a private equity buyer and I see a tiny food company with a 44% pursuit rate, my first instinct isn't to buy it. My first instinct is to assume the founder is cooking the books, or, I don't know, they have completely stopped investing in the business to artificially inflate their profits right before a sale.
That is exactly what a skeptical buyer would assume until they look at the specific column on that table that explains everything.
Which is?
The margin. If you look at the financial profile of that tiny food and hospitality deal, the EBITDA margin is listed at a staggering 40 to 45%.
Wait, they are keeping 45 cents of pure profit for every single dollar that comes through the door. In the food industry, where most restaurants are thrilled to keep 8 cents.
Right. And that margin is exactly why your skepticism would be misplaced here. A 45% margin tells the buyer that this is not a restaurant. It's not.
No, it is not a catering company either. You cannot achieve those margins selling food on a plate. This implies highly specialized intellectual property.
Like what?
It implies a uniquely scalable B2B food distribution model, or perhaps a food tech franchise system where they are collecting royalties without holding any physical inventory.
Okay. So buyers aren't looking at a tiny $1 million business. They are looking at an insanely efficient cash-generating machine that they can pump their own capital into and scale nationally.
Exactly. Pursuit rate is the ultimate indicator of high-interest, high-quality deals. It proves conclusively that you do not need to be a massive company to be highly coveted.
That is wild.
If your margins are exceptional, buyers will swarm you, regardless of your overall top-line revenue. Profitability efficiency is just as attractive as raw scale because it speaks to the fundamental health and pricing power of the business. That is such an empowering takeaway for a listener. If you have hit a ceiling on your revenue, maybe your local market is fully saturated, or you are constrained by warehouse space, you can still achieve elite status in the M&A market by ruthlessly pivoting to optimize your margins.
Without a doubt, margin is the ultimate equalizer in the lower middle market.
So we know your size matters, we know your industry dictates your audience, and your margins absolutely dictate your conversion rate. But that brings us to a really uncomfortable question about geography.
The map.
Yeah. Does a private equity buyer sitting in a high-rise in New York actually care about a manufacturing plant located in rural Ohio? Let's map out the geographic demand.
The report includes a very clear breakdown of where buyer interest is concentrated, and it does reveal some stark regional biases.
Yeah, the macro data shows that the South Atlantic and the Middle Atlantic regions are the absolute powerhouses right now. Together, those two regions on the East Coast accounted for nearly 40% of all year-to-date activity.
That's a huge concentration.
It is. That includes both the sheer number of deals coming to market and the total pursuits those deals generated.
Which aligns perfectly with broader macroeconomic trends. You have massive population centers, significant industrial bases, and generally favorable tax and business climates in many of those states. Capital naturally gravitates toward those hubs.
Okay, what about the rest of the country?
The report outlines the Tier 2 regions, the Pacific, the West, South, Central, and the Eastern Midwest. They are incredibly active, just not at the overwhelming volume of the Atlantic coast.
Okay, let me channel the anxiety of the founder listening right now. Let's say my business is based in the Northeast, up in Maine or Vermont. Or maybe I'm in the East, South, Central region, places like Kentucky, Tennessee, or Alabama.
Right, the lower volume regions.
The data explicitly says these are smaller volume, lower activity regions. They aren't the powerhouses. If I go to market, am I already operating at a massive disadvantage? Are these national buyers only flying to Florida and Texas to do deals? Am I going to have to accept a lower valuation just because of my zip code?
It is the single most common fear outside of the major hubs. But if we connect this to the bigger picture, this is where the raw data is incredibly vindicating for business owners.
Vindicating? How?
If we dive into the specific regional breakdown tables provided in the report, we can definitively prove that geography is not destiny.
Show me the proof. Because if I'm in Kentucky, I am feeling pretty nervous looking at that 40% concentration on the coast.
Let's look at the specific table for the Northeast region. The absolute most pursued deal in the entire Northeast was a business services company. It only had $1 to $5 million in top-line revenue, but it had $3 to $4 million in EBITDA.
Wait. If they only have up to $5 million in revenue and up to $4 million in profit, they're keeping roughly 70 cents on the dollar.
Exactly. The margin is listed at 70% plus. And because of that completely alien financial profile, that single small deal in the Northeast generated 114 independent pursuits.
Over 100 buyers raised their hand for a tiny business in a low-volume region.
Yes. Now, let's look at your exact hypothetical. The East, South, Central region, Kentucky, Tennessee. The number one deal in that region was also a business services company.
Okay.
It also had $1 to $5 million in top-line revenue. It also had $3 to $5 million in EBITDA, implying that same 70% plus margin. And how many pursuits do you think it generated?
Let me guess. 114.
Exactly, 114 pursuits.
That is uncanny. It is the exact same financial profile in two completely different lower volume regions, generating the exact same massive amount of national buyer interest.
It proves the point beautifully. The crucial takeaway for the listener is that buyer interest is highly distributed. Capital in the modern M&A landscape is highly mobile.
They aren't just looking in their backyard.
Not at all. Private equity firms and strategic buyers use platforms like Axial specifically so they are not limited by their own geographic footprint. They have remote due diligence processes. They have Zoom. A fundamentally sound business with a compelling financial profile will attract national attention regardless of its local zip code.
Because buyers are hunting for yield, not convenient flights.
Buyers are hunting for yield, not convenient flights.
Exactly. If you are a founder in a rural area, you need to write that on a Post-it note and stick it to your monitor. Do not let a local competitor or a local buyer tell you that your business is worth less just because of where it sits on a map. Capital is national.
Perfectly said.
Okay, we have looked at all the macro trends. Now, I want to put these companies under a microscope and look at the absolute freaks of nature. Let's deconstruct the all-stars. The report gives us a table of the top 25 most pursued deals across the entire platform.
This is where we can really extract the DNA of a perfect exit profile. We can see exactly what makes a deal an absolute magnet for capital.
I want to spend some time exploring these because the numbers are staggering. Let's start with a heavyweight champion of the report, the number one overall most pursued deal on the platform.
The big one.
It is a transportation company. Revenue is 20 to 25 million. EBITDA is 4 to 5 million. The margin is a very healthy 20 to 25%, and it generated an unbelievable 379 pursuits.
Almost 400 independent buying groups reviewed that teaser and requested to sign an NDA. That isn't just interest, that is a feeding frenzy.
Like insane.
And it perfectly encapsulates what we discussed earlier about the $5 million EBITDA threshold. It is sitting right at that 4 to 5 million mark, demonstrating solid scale, healthy margins in an asset-heavy industry, and it absolutely reaped the rewards of being in that sweet spot.
But the heavyweights aren't the only ones dominating this list. We talked about margin outliers earlier, and they are scattered all over this top 25 ranking. Look at rank number 6.
Yeah, this one is wild.
It's an industrial company. The top line revenue is only 5 to 10 million, but the EBITDA is 4 to 5 million, which means, once again, we are looking at a company keeping 70 cents on the dollar, and it generated 209 pursuits.
It is the 6th most popular deal on the entire network, and it has less than 10 million in revenue. It is beating out companies with 50 million in revenue simply because it is vastly more efficient.
Buyers will pay a massive premium for that, won't they?
A massive premium in terms of their time, attention, and ultimately valuation for operational excellence. A 70% margin in an industrial manufacturing business likely means they have some sort of highly proprietary process or, a patented component that absolutely dominates a specific supply chain with zero price competition.
I also have to point out the absolute monopoly that industrials have on this specific list. Out of the top 25 most pursued deals in the entire report, 15 of them are industrials.
More than half.
More than half the list is just heavy manufacturing and distribution, completely dominating the attention economy.
Which perfectly reinforces the volume data we looked at earlier. The depth of the buyer pool for industrials is truly staggering.
But it's not a complete monopoly, and this is where I need you to theorize for a second. I want to point out rank number 11. It is an agriculture deal. Now, when I hear agriculture, I think of tractors, dirt, and incredibly tight margins. I don't think of it as the hottest sector in high finance M&A.
Fair enough.
But this deal had 5 to 10 million in revenue, 3 to 4 million in EBITDA, resulting in a massive 30 to 35% margin, and it pulled in 190 pursuits. It beat out tech deals, consumer goods, and healthcare. I have a really hard time believing a traditional farm is beating out tech companies in 2026. What is actually going on there?
You are entirely right to be skeptical because a 35% margin in agriculture tells us immediately that this is not a traditional family farm.
Right.
You don't get 35% margins growing soybeans. This is highly likely to be an ag tech play. We are talking about drone-based crop management software or proprietary hydroponic systems or specialized genetic seed distribution.
Oh, so it's a tech company hiding in the agriculture category.
Basically. Buyers aren't buying tractors here. They are buying highly scalable food infrastructure. And because food security is a massive macroeconomic thesis right now, a highly profitable company in that space is going to trigger a bidding war.
That makes so much more sense. So if we synthesize all of these outliers, the transportation giant, the highly efficient industrial play, the ag tech anomaly, what do these all-stars actually have in common? What is the unifying thread here?
Almost all of them sit firmly in that $2 million to $6 million EBITDA band. They have proven they have institutional quality scale, but they are still small enough to appeal to the absolute maximum number of buyers.
And their margins.
And even more importantly, they almost uniformly boast margins well above the standard 10%. Whether it's 20%, 35%, or 70%, they are exceptionally profitable relative to their top-line revenue.
So size plus efficiency.
That combination accessible size plus elite efficiency is the true anatomy of an all-star deal.
Okay, we have analyzed this report from every conceivable angle. We've explored the size sweet spots, the industry weather patterns, the conversion rates, the geographic realities, and the freaks of nature.
We covered a lot.
So what does this all mean for you, the listener, preparing for an exit? Since the report doesn't explicitly provide a checklist, we're going to build one for you right now, based strictly on everything we've found.
Let's build that strategic blueprint right now.
If I am a founder listening to this on my commute, and I am thinking about selling in the next 2 years, I need a Monday morning game plan. I am sitting at my desk tomorrow with my CFO. What exactly is item number 1?
The very first thing you need to do tomorrow morning is benchmark your EBITDA band.
Okay, how do I use the data for that?
You need to know exactly where you sit in the eyes of the market. The data clearly shows that crossing the $1 million profit threshold is absolutely mandatory if you want to open the floodgates of institutional buyer activity. 72% of the total volume happens above that line.
So if I'm at 800K, my only goal is hitting $1 million.
Yes. Your entire strategic focus for the next 12 months is figuring out how to push over that $1 million hump before you go to market.
And if I am already over $1 million?
If you are at 2 or 3 million, you need to decide if you want to push for that $5 to $10 million sweet spot where average buyer interest peaks at 37 pursuits. Benchmark your current reality against the data and set your expectations realistically.
Perfect. What is checklist item number 2?
You need to evaluate your industry's dynamic. Map the weather in your specific sector.
Volume versus scarcity.
Exactly. Are you in a high-volume sector like industrials? If so, you know you have a massive audience waiting for you, but you also have to ask your advisor, how is our teaser going to stand out in a crowd of 700 other deals? You have to differentiate.
And if I'm not in industrials?
Or are you in a scarcity market like education or financial services? If so, you shouldn't panic if your total pursuit numbers seem lower than an industrial company, because you should expect a much higher pursuit rate from a smaller, highly targeted pool of invites. Knowing your weather dictates how you run your process.
I'll chime in with the third checklist item because we spent so much time debating it. Optimize for pursuit rate via margins.
Yes, margin is everything.
We saw with that tiny food business getting a 44% conversion rate. We saw it with the Northeast business pulling 114 pursuits on less than $5 million in revenue. The checklist item is this. If you hit a wall on top-line revenue growth before your exit, ruthlessly pivot to optimize your EBITDA margin. The data proves conclusively that 30, 40, or 70% margins can generate top-tier pursuit rates regardless of your overall company size.
Beautifully stated. And the final piece of the blueprint, item 4, don't let geography dictate your valuation. It is so easy to look at that macro data, see 40% of the activity happening on the East Coast, and feel discouraged if you operate in a rural or lower volume state. You have to acknowledge the regional patterns, but you must rely on the data showing that strong financial profiles easily overcome regional buyer concentrations.
Capital is national.
Do not accept a subpar deal structure just because a local buyer tells you that's how things are priced around here. Capital is mobile, and if your business is fundamentally sound, the buyers will fly to you.
That is an incredible blueprint. Benchmark the profit, evaluate the industry dynamic, optimize the margins, and leverage national capital.
It's actionable.
We've covered a massive amount of ground today. And I have to say, taking raw platform data, stripping away all the golf course rumors and country club anecdotes, and seeing exactly what buyers are actually clicking on, it completely demystifies the entire M&A landscape. It replaces the anxiety of the unknown with actionable clarity.
It really does. But before we wrap up, this raises an important question.
Oh, lay it on us. What is the final thought?
We have spent this entire deep dive analyzing what buyers are pursuing today.
Right, the first half of 2026.
But if pursuit activity is the very first impulse, the absolute top of the funnel, you have to remember the time lag of M&A. From the moment a buyer clicks pursue to the moment the funds actually hit your bank account, you are looking at 6, 9, maybe 12 months of negotiations, due diligence, and legal structuring.
Yeah, right. It is not a quick process.
So ask yourself, how long is the lag between what buyers are aggressively pursuing today and what the broader economy will be doing when these deals actually close 6 to 12 months from now? Are these buyers chasing today's realities or tomorrow's projections?
Oh, that is a fantastic point.
As you prepare your exit and as you build your management presentations, you cannot just sell your historical performance. Make sure your narrative answers both realities. You need to prove you are highly profitable today and structurally resilient enough for whatever the economy looks like on the day you actually sit down to sign the closing papers.
That is profound. Are you selling your past or are you selling their future? You have to build a narrative that survives the time lag. Well, if you are that business owner we talked about at the very beginning, staring out the blacked out window, wondering if anyone out there is actually looking at your life's work, hopefully we just turned the lights on for you.
Definitely out there.
The buyers are out there, and now you know exactly what they're looking for. Thank you for joining us on this deep dive. We'll see you next time.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.